I have Amazon and Alphabet rated as two of the top 9 stocks to buy right now in 2025. But which one is a better stock to buy? Let's say if you had to decide to buy only one of these two, which one is the better buy? That's the question I'm going to answer in this video. I'm going to compare these two across several important financial metrics, including revenue growth, operating margin, cash flow from operations, returns on invested capital compared to the weighted average cost of capital. I'm then going to look at their valuations on the forward price to earnings metric, and I've done discounted cash flow models on each Alphabet and Amazon, and I'm going to use all of that and my years of knowledge following these two companies to answer and rank these two, which one is the better stock to buy today. Let's jump in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Starting with revenue. Now, looking back at the last decade, they've both demonstrated excellent revenue growth, but Amazon has done a better job, growing its revenue to $638 billion. Alphabet has grown its revenue to $350 billion. But in recent quarters, and certainly for the next quarter looking ahead, Alphabet's growth prospects look better. Amazon guided for revenue growth of about 9% in the upcoming quarter, and the forecast for Alphabet is in the double digits. That being said, longer term, I suspect Amazon's revenue growth will be more so than Alphabet. That's because Amazon is a larger business, and 10% revenue growth for Amazon would mean more than $60 billion in revenue growth, whereas 10% revenue growth for Alphabet will mean $35 billion. So just because of the already larger scale, Amazon's growth rates may slow down, but its magnitude of revenue growth will be larger than Alphabet. Amazon is operating in several growth categories, including the e-commerce segment, which is expected to grow for at least another decade as more consumers spend more money online. And it also has the lucrative cloud segment, which is growing at close to 20%. And that's the category that houses the artificial intelligence segment, which is growing much, much quicker than the overall rate of growth for the business. Alphabet, meanwhile, also has the lucrative cloud segment that's growing at closer to 30%, but it's a much smaller part of its business compared to Amazon. And Alphabet's advertising businesses are growing robustly as well. Remember, advertising is a $1 trillion category worldwide in terms of annual spending, and Alphabet is the leading player in that category. Amazon is catching up in that category as well, but Alphabet is the leading player in that category. So they both have excellent growth prospects. In terms of revenue growth rate, maybe Alphabet will be better. In terms of overall revenue growth, Amazon will be better. Looking at operating profit margins, we see a clear advantage for Alphabet, and that's primarily because it doesn't have that e-commerce segment that Amazon has. Amazon's e-commerce segment is the least profitable segment of the business overall, and it weighs down on its margins, although it's been doing a much better job reaching economies of scale. And now the e-commerce segment, the margins in the e-commerce segment are growing quickly. And so Alphabet, 32% operating margin, and the trend is improving. Amazon, 11% operating margin, and the trend is improving. So they've both demonstrated excellent results in these categories of operating profitability. I would give the edge to Alphabet here in this regard. That being said, Amazon's businesses are much better protected, or they have stronger moats, if you will, compared to Alphabet's business, especially right now. Alphabet's search engine business, which is the largest profit generator of the business overall, is under pressure from large language models, and it's under threat from large language models. It's under open threat right now. Whereas Amazon's businesses, including e-commerce and cloud, are doing really, really well. And the e-commerce segment especially is very well protected from competitors. It'll be really difficult for any competitor to take a meaningful share from Amazon in its e-commerce segment. It's built such a competitive advantage in that category. Similar story in cash flow from operations to sales, although one minor difference is that Alphabet's cash flow from operations to sales are trending slightly downward over the last decade, whereas Amazon's are trending upward. They've almost doubled in the last decade cash flow from operations to sales. Amazon's business demonstrates a bigger difference between reported profits and reported cash flow because Amazon has a greater percentage of non-cash expenses, especially in depreciation, because of how much capital Amazon has spent on its fulfillment and logistics network. And those are primarily now non-cash expenses, as the company has already built and spent hundreds of billions of dollars in developing that network. The returns on invested capital, again, advantage to Alphabet here at 31% compared to 20% for Amazon. But it's also important to compare the return on invested capital with the company's weighted average cost of capital. So let's do that. So Amazon had a return on invested capital of 20%, and Amazon's weighted average cost of capital is 11%. So a roughly 2-to-1 ratio here from return on invested capital to weighted average cost of capital, which is very good. Alphabet, meanwhile, had a return on invested capital of closer to 30%, and its weighted average cost of capital is closer to 10%. And so it has a 3-to-1 ratio here in return on invested capital to weighted average cost of capital, which of course is much better than Amazon's 2-to-1 ratio. So now that we looked at all the critically important financial metrics, let's look at valuation. And you got a glimpse of my discounted cash flow model when I shared with you the weighted average cost of capital, but I'll share that with you again soon. Let's start with the price to earnings forward ratio. On this metric, Amazon is considerably more expensive, trading at a forward PE of 30 compared to the forward PE of 18 to Alphabet. And when I look at my discounted cash flow models, they are both undervalued according to this metric. Alphabet has an intrinsic value, according to my calculation, of $238. Its current market price is $184, so undervalued according to this metric as well as looking at the forward PE. And similar to Amazon, Amazon's intrinsic value per share is $286. The current market price is $226. So hopefully you understood between all of these things I discussed in this video why I like both of these companies, and I have both of them rated as, my top stocks to buy right now in 2025. But if I had to pick just one of them, Alphabet edges out Amazon in terms of reward versus risk, given its better performance on return on invested capital to weighted average cost of capital, better margins, better cash flow, and the lower valuation compared to Amazon. So if I had to pick just one, I would pick Alphabet as the better stock to buy between these two. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.